I want you to pay attention to something that most investors are not paying attention to. A major shift is taking place in energy, power, infrastructure, and artificial intelligence. It does not look as exciting on the surface as a new chip announcement. It does not sound as glamorous as another story about NVIDIA. It is not the kind of thing that social media likes to talk about every day. But in markets, the most important opportunities often begin in places that look boring. The United States has an old power grid. Artificial intelligence is creating a new kind of demand. Data centers are being built faster than the grid can handle. The government has now moved to treat grid reliability and power security as a strategic priority. When those pieces come together, capital begins to move. And when capital begins to move, investors who understand the system should not ignore it. The point is not to chase headlines. The point is to understand the machine. The machine is simple. AI needs power. The grid is old. Data centers cannot wait 10 years for utility approvals. Government policy is now pushing capital toward grid reliability. Companies that build, supply, cool, connect, and power this system are standing in the path of that capital. That is the structure. Most people are still watching the obvious part of the AI. Boom, they are watching chips, they are watching software, they are watching the companies that became famous first. But when a boom grows large enough, the pressure moves down into the foundations, it moves into energy, land, cooling, copper, transformers, transmission lines, switchgear, fuel cells, nuclear fuel contractors, and the physical systems that make the digital world function. That is where the next layer of the story is. The first thing to understand is that AI is not just a computing story. It is a power story. A data center is not just a building filled with servers. It is a constant demand on the electrical system. It needs power during the day. It needs power at night. It needs cooling. It needs redundancy. It needs reliability. It cannot operate like a normal office building that can tolerate a temporary slowdown. A modern AI data center is closer to a factory that never sleeps. That is why the numbers matter. AI data centers already require a level of power that can be compared to tens of millions of American homes. By 2030, that demand is expected to more than double. At the same time, a large share of America's transformers are more than 25 years old. The grid was built for a different age. It was built for homes, factories, refrigerators, air conditioners, and a much simpler pattern of demand. It was not built for AI supercomputers running continuously. That mismatch is what creates the opportunity. When demand rises faster than infrastructure can adjust, one of two things happens. Either growth slows down or the infrastructure gets rebuilt. In this case, the companies that need power have too much money and too much urgency to wait passively. So they are beginning to do something that changes the structure of the market. They are going off grid. They are building or contracting for their own sources of power. They are signing power purchase agreements. They are looking at fuel cells, natural gas systems, small nuclear reactors, uranium private generation, and anything else that can provide reliable power close to the data center. This is an important development because it means private companies are beginning to act like utility companies, at least for their own needs. That is not a small thing. It changes where money flows. It changes which companies get contracts. It changes which industries become strategic instead of optional. When I look at a shift like this, I do not start with individual stocks. That is not how I think about markets. I start with cause and effect. The cause is that AI requires enormous amounts of reliable electricity. The effect is that the grid must be upgraded, expanded, stabilized, and supplemented. The next effect is that capital flows to companies that provide power generation, grid construction, electrical components, cooling systems, fuel, and raw materials. Only after understanding that chain do I look at companies. Most individual investors do the opposite. They hear a ticker, they see a stock chart, they watch a video, they buy because something has already moved. That is not a system, that is reaction. A better principle is to follow the money. That phrase sounds simple, but most people do not actually do it. They follow opinions, they follow stories, they follow fear, they follow excitement. Institutional money follows flows, contracts, backlogs, policy, and capital allocation. That is why it often moves before the average investor understands what is happening. You can see it in the relative performance while the broad market may move only a few percentage points over a certain period. Certain power line construction companies can rise much more. Engineering and construction companies can move much more. Electronic component companies can move much more. Individual companies tied to the grid, data center power, cooling, and electrical infrastructure can move dramatically while the index looks almost flat. That is not magic. That is sector rotation. Money moves from one area to another. It does not leave the world. It changes location. When investors only stare at the index, they miss the fact that beneath the surface, entire industries may be in strong trends. This is one of the big mistakes people make. They say the market is doing nothing. But what they really mean is that the part of the market they are watching is doing nothing. The market is not one thing. It is a system of many subsystems. Capital moves through those subsystems like water moving through channels. If you understand where the pressure is building, you can understand where the flow may go. Now, the policy layer matters. An executive order focused on grid reliability and security is not just a political headline. It is a signal about priorities. it gives energy and power reliability a higher strategic importance. It can keep existing power plants operating when capacity is needed. It can accelerate long-term power purchase agreements for critical facilities. It can support transmission upgrades and infrastructure spending. The details are less important than the direction. The direction is clear. The grid is becoming a national priority. Again, that means coal and gas plants that were expected to retire may be kept online because the system cannot afford to lose capacity. It means natural gas remains important because it provides dependable power when solar and wind are not producing. It means government-related power contracts become valuable because long-term revenue stability matters to investors. I am not making a political argument. I am looking at incentives. Data centers need constant power. The military needs constant power. Critical facilities need constant power. When demand becomes urgent, the system pays for reliability. And when the system pays for reliability, companies that provide reliability become more valuable. This is why backlogs matter. A backlog is one of the clearest signals in this kind of market. It is not a projection. It is not a dream. It is work that has already been sold. It is signed demand. It is future revenue that a company is expected to earn because customers have already committed. When a grid contractor has tens of billions of dollars in backlog, that tells you something. It tells you that demand is not only theoretical, it has become contractual. That is a very different thing. Revenue projections can be wrong, narratives can change, analysts can get excited and then disappear, but backlogs show you where real spending has already been committed. In infrastructure, that is especially important because these projects often take years. The work does not vanish overnight because the market has a bad week. A company like Quanta Services is an example of the type of business that sits directly in the path of this spending. It builds transmission lines, substations, and the physical grid systems that allow electricity to move. When the grid needs expansion, these are the kinds of companies that do the work. A large backlog is therefore not just an accounting item. It is a window into demand. This is how I would think about the opportunity set. The first category is off, grid power generation. This is one of the most important categories because the waiting time for grid connection can be very long. If a technology company wants to build a data center and the local grid cannot support it quickly, the company has a problem. AI development is moving in months, not decades. Utility approvals, transmission upgrades, substations, and permitting can take many years. So large companies look for another path. They can build or contract for power closer to the data center. They can use fuel cells. They can use natural gas generation. They can look at small modular nuclear reactors. They can enter into long-term agreements with energy providers. They can become less dependent on the legacy grid. That creates demand for companies such as Bloom Energy, which makes fuel cell systems that can generate electricity on site. The core idea is straightforward. Instead of waiting for the grid, a data center can place power generation close to where the power is needed. That is valuable when reliability and speed matter. Another part of the same category is small modular nuclear power. Nuclear is controversial, but in markets I try not to make emotional judgments. I look at trade-offs. Nuclear has the advantage of producing large amounts of reliable power without the same intermittency problem as wind or solar. If large technology companies want power that runs continuously and can be described as low carbon, nuclear becomes attractive again. That is why companies connected to small modular reactors become interesting to watch. If nuclear demand rises, uranium also matters. Every reactor needs fuel. Supply has been constrained because for years the world was not aggressively building new reactors. If demand changes faster than supply can respond, uranium producers can become the picks and shovels of the nuclear side of this build-out. That is the first layer. The second category is the physical grid builders. These are the companies that build the actual system: transmission lines, substations, pipelines, power plants, electrical infrastructure, mechanical systems. These are not the flashy companies that dominate social media, but they may be essential to the AI build-out. Quanta Services is one example because it is a major North American grid infrastructure contractor. Mastec is another type of company to study because it builds pipelines and power lines. Argon works in power plant construction. Comfort Systems works on mechanical and electrical contracting for data centers. The important principle is not that every company in this category is a buy. The principle is that this category is where the spending must go if the build-out continues. A data center is not only chips and software, it is electricity, cooling, construction, wiring, maintenance, and systems integration. When investors forget that, they miss the less obvious winners. The third category is components. If the grid is the picks and shovels of AI, then components are the picks and shovels of the grid. Every data center, substation, power plant, and transmission system needs specialized parts: power modules, switchgear, circuit boards, cooling systems, transformers, electrical distribution equipment. These are not easy businesses to enter. There are technical requirements, customer relationships, quality standards, safety standards, and capacity constraints. That matters because when demand rises sharply, the companies already positioned in these component niches can benefit. Vicor is an example of a company connected to power conversion. Modern chips and servers need power conversion systems. Powell Industries makes switchgear and electrical distribution equipment. Vertiv is tied to thermal management and cooling, which is essential because AI chips generate enormous heat. TTM Technologies and Advanced Energy Industries are examples of companies in the broader electronics and power infrastructure chain. Again, the principle is the same. Do not memorize names without understanding the system. Understand what the system needs, then identify who supplies it. The fourth category is raw materials. You cannot rebuild the grid with speeches. You need physical materials: aluminum, copper, uranium, steel, transformers, conductors, wiring, fuel. These are not optional inputs if a large infrastructure cycle begins. The material demand follows. Aluminum matters for transmission lines and conductors, copper matters for wiring and transformers, uranium matters if nuclear becomes part of the solution. Domestic materials can also become more important. If tariffs or policy preferences favor American supply chains, this is why material companies can become part of the trade, even if they do not look like AI companies. An investor who only searches for AI in a company description may miss the companies supplying the infrastructure that AI requires. That is a common error. The label is not what matters. The cash flow path matters. There is another important point here. Many investors think that if a stock has already gone up, the opportunity is over. Sometimes that is true. Often it is not. Strong trends can last longer than people expect because institutions do not allocate all their capital in one day. They build positions, more investors notice, more data confirms the thesis, more contracts arrive, earnings estimates get revised, backlogs grow, then additional capital enters. This is why being a little late is not always bad. In fact, being too early can be dangerous. If you buy before the evidence appears, you may sit through years of dead money or losses. If you buy after the evidence begins to appear, you may miss the first move. But you may also reduce the probability of being completely wrong. Markets are about probabilities, not fantasies. I do not want to be the first person in an empty room. I want to see that the room is starting to fill and that the reason is real. That is why backlogs, contracts, relative performance, and policy support matter. Now let me give you the framework. The first step is to zoom out and identify the undeniable trend, not a rumor, not a prediction, not a story someone wants to sell. An undeniable trend, something already happening at a scale that is too large to ignore. In this case, the trend is that AI demand requires more power. The existing grid is old. Data centers are being built, and government policy is supporting reliability and security. That is already happening. The second step is to identify who benefits from that trend. Do not start with the stock, start with the economic need. If AI needs power, who provides power? If the grid needs expansion, who builds grid infrastructure? If data centers need cooling, who builds cooling systems? If transmission lines need materials, who produces the materials? If long-term reliability is required, which companies can sign contracts and fulfill them? That is how you move from macro to sector to company. The third step is to look for proof in the data: backlogs, contract wins, revenue growth, margin expansion, sector relative strength, volume, price behavior, capital spending plans. These are the signals that tell you whether the money is actually moving. Do not rely only on the story. Stories are cheap. Evidence matters. If a stock is moving because a narrative is popular but the company has no contracts, no revenue, no backlog, and no path to profit, that is speculation. It may work for a while, but it is fragile. If a company is moving because it has signed work, growing demand, and a clear role in a structural build-out, that is a different kind of setup. This is how I think about following the money. Most people wait for financial television to explain the opportunity. By then, a large part of the move may already be underway. The data is usually public before the story becomes mainstream. The problem is not that regular investors are denied access to the data. The problem is that they are watching the wrong things. They watch headlines. Institutions watch flows. They watch opinions. Institutions watch contracts. They watch the index. Institutions watch sector rotation. They wait for certainty. Institutions act when probabilities become attractive. That difference is enormous. There will always be uncertainty. Maybe the grid trade continues. Maybe it pauses. Maybe some stocks have already moved too far. Maybe a better entry point comes later. Maybe the next rotation goes somewhere else. That is normal. Investing is not about knowing the future with certainty. It is about building a process that helps you respond to the evidence as it changes. If the money stays in the sector, you study it. If the money leaves, you do not marry it. You rotate. That is how professionals think. They are not emotionally attached to yesterday's story. The bigger lesson here is not just about energy. It is about how markets work. Every major technological boom eventually creates bottlenecks. The first investors chase the visible winners. Then the bottleneck reveals the next group of winners in AI. The first visible winners were chips and models, then came data centers, then power, then cooling, then grid infrastructure, then materials. Each layer reveals the next. This is why systems thinking matters. You cannot understand a boom by looking at one company. You have to understand the whole chain. What is required, what is scarce, who controls the scarce input, who has pricing power, who has contracts, who can execute, who has a backlog, who benefits whether the headline company wins or loses. That is the way I try to think. I do not need to know exactly which AI model wins. I do not need to know exactly which chip dominates forever. I need to understand that if AI expands, power demand rises. If power demand rises, the grid must be rebuilt or supplemented. If the grid must be rebuilt or supplemented, capital flows to the builders, component suppliers, power providers, and material producers. That is a more stable line of reasoning. It is also why the word boring can be dangerous. Boring is often where the money is. Boring companies build the substations, boring companies install the transmission lines, boring companies make the switchgear, boring companies produce the materials, boring companies sign long-term contracts, boring companies sit in the middle of the real economy while exciting companies take the headlines. A mature investor does not need excitement, he needs reality, and reality is that the AI boom is creating physical world consequences: more electricity, more cooling, more construction, more materials, more infrastructure, more government attention, more long-term contracts. That is not a small story. Now, I also want to be careful. A real trend does not mean every stock tied to the trend is good. Some will be too expensive, some will execute poorly, some will dilute shareholders, some will fail to convert demand into profit, some will move too far and then fall sharply. A good theme does not eliminate risk. This is why position sizing and discipline matter. You do not take a story and turn it into blind concentration. You study the chain. You identify the strongest links. You decide what price makes sense. You manage downside. You do not confuse being right about a trend with being right about every company inside that trend. That is one of the biggest mistakes in investing. A sector can be right and your stock can still be wrong. The right process is to separate the layers. First, is the macro trend real? Second, is the sector benefiting? Third, is the company positioned? Fourth, is the valuation reasonable? Fifth, is the chart and flow confirming that money is entering? Sixth, what is the risk if you are wrong? That is a much better process than simply saying AI needs power, so I will buy anything with power in the name. I have seen many investors lose money by being right in a general sense and wrong in a specific sense. The goal is not to be enthusiastic, the goal is to be accurate. So what is the main lesson? The market is not dead when the index is flat. Opportunity can exist inside the market even when the broad market looks frustrating. Money is always moving. Sometimes it moves into technology, sometimes into energy, sometimes into defense, sometimes into metals, sometimes into healthcare, sometimes into infrastructure, sometimes into companies nobody was talking about 6 months earlier. Your job is not to predict every move. Your job is to build a framework for detecting where the move is happening right now. The power and grid story deserves attention because the cause and effect chain is clear. AI demands power. The grid is old. Data centers cannot wait. Government policy is supportive. Contracts and backlogs are visible. Certain sectors have already shown strong relative performance. That is enough to study seriously. It is not enough to gamble blindly. There is a difference. If you want to become a better investor, stop asking only, what stock should I buy? Start asking, where is the money moving? Why is it moving there? What evidence confirms it? And what would prove the thesis wrong? That is how you stop reacting and start thinking. That is how you move from being a consumer of financial stories to being an observer of financial systems. And when you understand systems, you begin to see opportunities before they become obvious to everyone else. That does not mean you will always be right. Nobody is always right. I have been wrong many times. Every serious investor has, but a strong process allows you to be wrong in a controlled way and right in a way that matters. This energy and grid build-out may continue for years. It may also have sharp corrections along the way. The companies involved may run too far, then pull back, then run again. That is normal. Structural trades do not move in straight lines. They move in waves because capital moves in waves. But the deeper question is not whether a stock is up this week or down this week. The deeper question is whether the economic system is demanding more electricity and whether the companies supplying that demand are seeing real revenue, real contracts, and real backlogs. That is where I would keep my attention in a world of large debt, geopolitical uncertainty, inflation pressure, energy stress, and artificial intelligence expansion. The countries and companies that control reliable power will matter more than most people understand. Power is not a side issue, it is the base layer. Without power, there is no data center. Without data centers, there is no AI scale. Without grid investment, there is no reliable growth. Without components and materials, there is no grid investment. That is the chain. Follow the chain and you follow the money. Ignore the chain and you will spend your time wondering why certain stocks move while the market seems to be doing nothing. The opportunity is not hidden, it is public. The executive orders are public, the backlogs are public, the stock performance is public, the contracts are public, the demand is public. What is not common is the discipline to connect those facts before everyone else does. That is what investing requires. Not panic, not hype, not blind optimism, not fear, a clear view of reality, a cause, an effect map, and the discipline to act only when the evidence is strong enough. That is how I would think about this moment. AI has created a power problem. The grid has created an infrastructure problem. Policy has created a spending channel. Companies with the right capabilities may turn that spending channel into years of revenue. That is the setup. Now, the work is to study it carefully, size it intelligently, and remember that the goal is not to be excited. The goal is to be on the right side of the flow before the flow becomes obvious.